Good afternoon, good morning, or in my case, good evening to anybody that's listening to this continuing education section about sale-leasebacks. My name is Luke Timmis, and I will be presenting to you everything that you need to know about sale-leasebacks. I'm sure a lot of you folks have been hearing all the buzz about sale-leasebacks out there, and I'm happy today to help provide some insight into this new sort of cutting-edge corporate financing strategy for different businesses. I started my business about 10 years ago, and I've been working in this field exclusively doing sale-leasebacks. I've never had a sign on a building. I've never done tenant representation. I've never sold a piece of land. I don't sell empty buildings. All I do is sale-leasebacks. And so today I'm very happy and very excited to present to you some of the things that I know, and would love to, as we get farther down the line, talk about some of the ways that we might be able to work together and make some money helping businesses maximize the value of their real estate by utilizing the sale-leaseback tactic. I'm going to share my screen along the way. I've provided a PowerPoint presentation that covers a number of different points, but I'll flip back and forth between the camera and the PowerPoint presentation. And I guess without further ado, we'll continue on into our journey into sale-leaseback knowledge. So I'll share my screen with you guys for a second. Hopefully that you can see that all right. Today's section is about sale-leasebacks and everything you need to know. Today we're hoping that that you guys come away with some information that helps your clients, really. And this is all about maximizing value of the real estate for your clients, right? And so I hope that you guys get something out of this, and I really appreciate you guys listening. Start of a sale-leaseback business. How did I get into this? I was in a school project back in college, and the assignment was to value a business that was located in Texas, and they made highly engineered components for cars. And I provided you a very highly engineered component, as you could see in the PowerPoint slide. And I can remember being 20 years old and thinking to myself, I have no idea how a car works. I've never fixed cars. I don't know how this highly engineered component works. And so it was very difficult for me to understand the value of the business because I didn't have much context as to how the business worked. So instead of buying or putting together a valuation for the business, I kind of scratched the rules of the case study and said, you know what, I'm not going to value the business. Instead, I'm going to provide a liquidation event on the real estate. And so what I did was, instead of putting together a valuation for the operating company, I structured a sale-leaseback of the real estate. And at the time, I had a student CoStar account, so I could look up the building. And I provided my presentation. I remember thinking to myself, I'm either going to get an F or an A on this. I'm not sure. But the professor actually enjoyed the kind of outside the box thinking on the case study. And I really started to obsess over this concept for the next couple of years. And when I started interviewing with different companies, I pitched this idea of sale-leasebacks to different folks, and ultimately ended up at Signature Associates. Today in 2023, I'm a partner at Signature Associates. I'm also a principal and leader of the head of the investment sales division, which primarily we're doing sale-leasebacks. But it all started at Marquette University in Wisconsin, a little private college that gave me the opportunity to think outside the box. And ultimately, I turned it into a business. And so for those of you who do not know what a sale-leaseback is, what is a sale-leaseback? Well, a sale-leaseback is an arrangement where corporately owned real estate is sold to an investor in exchange for a long-term lease. Okay. Think about a business. It could be a car wash. It could be a furniture store. It could be an automotive components manufacturer. They own their own building. They can sell that building outright in exchange for a long-term lease to an investor. It's an interesting concept where the seller of the property becomes the tenant and the buyer of the property becomes the landlord. And what the sale-leaseback allows is for the seller to unlock stagnant capital that would otherwise be doing nothing, take that out of the real estate and inject it back into their business. Now they can use these proceeds to grow the business in a number of different ways. They can invest in new product lines. They can invest in new machinery that results in higher output and more production. They can hire more employees, or they can start another location. There are lots of uses that you can utilize this capital for. And so that's what I started to obsess over, was this idea. Now, we'll continue on to the next slide here. What you'll commonly be asked is, well, what are the benefits of doing a sale-leaseback? Well, why would I do it? A lot of business owners, they own their own real estate, they own their business, and they think of owning the real estate as being more or less a hedge on their overall portfolio, right? They've got stocks, they've got bonds, they have their business, and they have real estate. But in reality, their business, and oftentimes the business is located in, say, Livonia, Michigan, and the real estate is located in Livonia, Michigan. So I wouldn't call that a very well-diversified portfolio. So in a way to kind of diversify your overall holdings, it's sometimes a very strong strategic move to get out of your real estate and diversify into other interests. Now, the number one benefit of, or the number one bullet point that we have here in terms of benefits of a sale-leaseback, I want to talk about the idea of the S&P 500 and the growth trajectory of the S&P 500 since its inception. The S&P 500, for those of you who don't know, that's an index fund. What's an index fund? Well, the S&P 500 is one stock that is representative of the 500 largest companies in the United States. So you can think of ExxonMobil or Apple, Google. These are all companies that are components of the S&P 500. Why am I bringing this up? The S&P 500, since its inception, has doubled every 7 to 10 years since it started. Every 7 to 10 years. That means if you put $1 in the S&P 500 100 years ago, it will have compounded 10 times. That's 2. 1 turns to 2, 4, 8, 16, 32, 64. Hope most of you understand, or all of you understand, the concept of compound interest. Well, if you look, the reason why I bring this up is if you look at the appreciation of value, let's say, of a property on the outskirts of Toledo, Ohio. Let's take an industrial building, for example. An industrial building that was built in 1973. It's in the outskirts of Toledo, Ohio. What does the appreciation of value of that real estate look like? Well, if you compare it to the trajectory of the S&P 500, I can tell you that since 1973, when it was built, it has not doubled every 10 years or 7 to 10 years like the S&P 500 does. So whenever someone asks you what is the benefit of doing a sale-leaseback, well, you can say, for starters, you could take that capital that would otherwise remain stagnant in the real estate doing nothing, and you can put it into the S&P 500, the most popular index in the United States, and that money will double every 7 to 10 years. I think for a lot of folks here listening today who have expertise in, say, industrial properties, they understand that at least since the president of my company started in the commercial real estate world, Steve Gordon, who's been doing industrial for 40 years, he always says to us that, industrial properties have really, on average, have ranged between 40 and 60, 70 bucks a square foot over the course of time. Now, of course, you see a lot of properties that trade above that, but I'm talking about on average, right? Whereas the S&P 500, again, if you put $1 into it 100 years ago or 50 years ago or 20 years ago, it will have compounded twice. It would have gone from $1 to $2 to $4 over the course of 20 years, right? Real estate doesn't move or appreciate in value in the same way that the S&P 500 does. So the first and foremost benefit, I think, for people to understand is, well, if you were to take this money and put it in the S&P 500, that S&P 500 stock would appreciate at a faster rate than the appreciation of value on the real estate that you own in the outskirts of Toledo. Now let's throw in another scenario. What if you were to take the proceeds of a sale-leaseback, and put it back into your company. Well, it's a pretty logical move. And in fact, most sale-leasebacks, that's the case. That's what companies are doing. They use the proceeds from the sale-leaseback, inject it back into the business, and they use it in an offensive manner to grow the business over time. Chances are, if you're in a business that makes rubber components, or you make computer screens, or you make lights, or you do car washes, or you run a furniture store, the chances are is the reason why you're in that business is because you have a knack for it and you understand this niche very, very well. And you are likely to grow your wealth at a faster pace by taking on different sort of taking on different ventures within this niche, whether it's the furniture business or the car wash business. So the idea of taking the proceeds out of your real estate and injecting it back into your business that you know best, as Warren Buffett says, invest in what you know best, invest in yourself. So that's kind of the idea is you could, in theory, if you put the money in the S&P 500, it would certainly outpace the growth of your commercial real estate that you own as a business. But if you were to take those proceeds and inject them back into the business that you own, I would bet that pace or that appreciation of growth would outpace even that of the S&P 500. That's what you see normally in a sale-leaseback is the proceeds are injected back in the business. I think a second thing that is very important to understand for everybody listening today is the fact that sale-leasebacks typically generate a 25 to 50% premium above appraised value. That's if you run the process the right way. Too many folks go out there and flip sale-leasebacks to their buddy who's a real estate investor. You don't want to do that. You can get yourself in trouble for not performing your fiduciary duties, and we'll talk about that more. But why are sale-leasebacks generating a 25 to 50% premium to appraised value? Well, appraisals typically take into account mostly comparable sales and cost approach. Of course, in every appraisal, there is an income approach, but the income approach, in most cases, it doesn't take into account, well, what if this building had a 15-year lease on it and a corporate guarantee from a successful company that has healthy financials with 3% annual rent escalations? What does that valuation look like? Well, the appraisals don't necessarily take that into full account. And so appraised value is largely driven by brick and mortar and by comparable sales. So if you look at sale-leaseback value versus appraised value, well, the sale-leaseback value, you're getting the bricks, the sticks, the ceiling height, the roof, the parking lot, the outer walls, etc. But you're also getting cash flow that's backed by a business, and that cash flow comes over the course of time. So there's a premium to a sale-leaseback as opposed to just the general value of a piece of real estate. Number three, folks say, well, what's the benefit of doing a sale-leaseback, right? So you can talk about the S&P 500, or you can talk about normal company growth and using the proceeds to grow the business. You can also talk about how sale-leasebacks generate a 25 to 50% premium to appraised value. But I think another idea or another thing to think about is it's an advantageous financing tool. I think most folks, when they think about taking on capital to grow their business, they think about, well, I could take on an equity partner. They could provide me with the capital that I need to grow this business. Alternatively, businesses will look at talking to a bank and taking out a traditional loan, right? And so the sale-leaseback is an interesting corporate financing tactic that avoids selling your equity, which means relinquishing control of your business to somebody else. It also avoids the idea of financing your company with bank debt, which have covenants and other rules and regulations that you have to abide by. The bank breathing down your neck and making sure that you're making those payments, right? So the sale-leaseback has become a very unique tool to financing your business, as opposed to selling equity of the company or taking on debt. Fourth concept here that I want to talk about is the concept of EBITDA multiples and cap rates. Some of you folks might say, well, what is EBITDA? Well, EBITDA is the profitability metric for an operating company. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And this is the metric that all companies use to measure the profitability. It's important to understand that every operating business, the value of an operating business, is based on a multiple of the EBITDA. What does that mean? Well, if a company's doing, say, $10 million in revenue and $1 million in EBITDA, and let's say it's sold at a 7x multiple, the company would be worth 1 million, that's the EBITDA, times 7. That's $7 million company, right? Now, the reason why I bring this up is because in real estate, we use cap rates to value investment properties, right? And if you guys are familiar with the equation that we use to equate the value of an investment property, it's the net operating income, or NOI, divided by the cap rate, right? And so net operating income, or NOI, that's real estate vernacular for the equivalent EBITDA. NOI, or net operating income, is EBITDA. It's the same thing. We just use a different lingo in the real estate world. Now, the interesting part about this, they say EBITDA multiples versus cap rates. Well, they're effectively the same thing. I'll elaborate. Cap rates, as we know, the cap rate calculation is NOI divided by cap rate. Well, as you learned in elementary school, if you divide by a decimal, you're really dividing by a fraction. NOI divided by 7% cap rate, let's say. NOI divided by 7%, well, that's NOI divided by 7 over 100. Or alternatively, it's NOI times 100 over 7. You have to multiply by the reciprocal. I hope you guys are still following. The reason why I want to bring this up is cap rates and EBITDA multiples are effectively the same thing. The cap rate is just the inverse. Now, I've got a table here that describes exactly what I'm talking about. So a 4% cap rate would be an equivalent of a 25 multiple on the net operating income of that property. A 5% cap rate would be a 20 multiple on the net operating income of that property. The reason why I wanted to bring this up and why it's so important is because middle market operating companies, like I said, they trade based on a multiple of their EBITDA. Well, EBITDA multiples for middle market companies, let's say automotive suppliers, all in and around Detroit, typically they trade in the ballpark of 5 to 8 times the EBITDA. Interestingly enough, if that same company were to turn around and do a 15-year sale-leaseback on their building, they would achieve something in the ballpark of a 7 to 8% cap rate. A 7% cap rate, as you can see here on the chart, is a 14.3 multiple. This is a substantially higher multiple than the going multiple for the operating business. I find that very interesting, and that is probably the main reason why I was so intrigued by the whole idea of sale-leasebacks, was the idea that real estate multiples, or cap rates, are much higher than EBITDA multiples for middle market businesses. So we'll continue down the line here. I don't want to get too far into it, but that's something to me that is very, very fascinating. The fact that investment bankers and M&A professionals have dubbed the valuation of an operating company is based on a multiple of EBITDA, whereas investment real estate professionals value buildings on cap rates. Effectively, it's the same thing. I find that fascinating. Benefits, right? Benefits of sale-leaseback. It's all about investing in what you know best. We talked about Warren Buffett's famous quote, right? And investing in new machinery, investing in new location, investing in new product lines, investing in a strategy that you know damn well is going to make you more money than the appreciation of your building in the outskirts of Toledo, Ohio, let's say. The next idea here is the maximization of enterprise value, and this goes along the lines of the EBITDA cap rate conversation. If you were to bifurcate the real estate and the operating company as two separate entities and sell them separately, you'd receive, in our first scenario, you'd receive a 7% cap rate for the building. You'd receive, which is a 14.3 multiple, as you can see in my chart. And then you sell the business, say at a 7 multiple. Well, the net effective multiple for the overall enterprise, business and real estate, is much higher than 7 times which is 7 times is the going EBITDA multiple for the company. You add a 14.3 multiple for the real estate. You are effectively maximizing the enterprise value of the overall organization. The last benefit that I have here, which I find equally as fascinating, is the idea of using the sale-leaseback as an estate planning tool. Think about multi-generational businesses, for example. Dad started a business 30 or 40 years ago, wants to harvest the fruits of his labor, wants that liquidity event he's been waiting for his entire life. But his son and his daughter are now running the company, and relinquishing equity in his company and selling it to a competitor might mean that his kids are now out of a job, or maybe they're not getting paid as much as they were before, or maybe they don't hold the same title. They don't get to be CEO anymore once they sell it. Alternatively, if you don't sell the equity of the company, another way of creating a liquidity event for this sort of situation is to go out and get a senior loan. Well, if you get a senior loan, you're now dealing with the bank. You're now dealing with sleepless nights. You're now burdening that next generation with a lot of stress and unwanted covenants and rules and regulations that they have to abide by. And not many people like the bank breathing down their neck. So, the idea of some people would rather deal with a new landlord than deal with a bank lender. So we'll move to the next page here. Understanding finance fundamentals. This is absolutely imperative. Why? Well, you can really miss the mark on a sale-leaseback. We've seen it before, and we've seen people get sued for it. Why? Well, they weren't competent. They didn't understand some of the concepts that are on this page. I think number one, important to understand, is the idea of compound interest. The idea that as things appreciate in value, or as securities appreciate in value, they compound over time. They build on themselves, which means 1 to 2 to 4 to 8 to 16, 32, 64, etc. That's the idea of compound interest. Understanding, then you see this next this next bullet here, which is important to understand. There's no way you can effectively put together an accurate valuation for an investment or for a sale-leaseback without understanding the financial statements of the company. You have to go through the income statement. You have to go through the balance sheet to understand truly what's the financial health of the company, because as you must know, the biggest driver of value for a sale-leaseback is the financial health of the guarantor of the lease. What is an income statement? An income statement is like a P&L. It's a profit and loss statement. It shows the revenues at the top. It shows the expenses. And then at the end, it equates an EBITDA, which, as we said, is the profitability metric used for businesses. What is a balance sheet? Well, balance sheet measures what are the liabilities versus the equity. How much cash does this company have on hand, and how much debt do they have on the balance sheet? For some of which might be long-term debt, some of which might be short-term debt, some might be due next week, and other debt vehicles that they might have on the balance sheet might be due 10 years from now. It's imperative to understand these different parts, because if there is a massive balloon payment loan due in short time, and the company isn't producing enough free cash flow or have enough cash on hand to retire that debt, that sounds like a company that isn't very healthy. Now, the income statement might report that it's a profitable business, but if that profitable business has a extremely high debt level on the balance sheet, It's actually not very healthy. Statement of cash flows, a cash flow statement. Statement of cash flows is basically it's a document that tracks all the inbound and outbound cash or capital that goes into the company and out of the company. That could be, the paying of the employees or the receiving of capital for a product. It could be the investment in a new machinery versus the revenue that is generated by that particular machine. You've got to understand all three of these different documents in order to properly calculate and understand the financial health of the business. The third point I bring up here is discounted cash flow modeling. It kind of shocks me how many people in this business that are doing investment sales or sale-leasebacks that don't even know about the existence of discounted cash flow modeling. What is discounted cash flow modeling? I don't expect the majority of people to know what it is unless you have a finance degree or an MBA. But a discounted cash flow model it's essentially a program that you build in Excel or some other programming sort of platform, and it measures the return of an investment over a defined horizon, a defined period of time. A cap rate, alternatively, only captures value at one point in time. It's 1 year of cash flow divided by the value of the building. What we're trying to find in discounted cash flow modeling is the internal rate of return. That's the IRR. The IRR is the most accurate depiction of what the return would be for a given investment. Interestingly enough, if your son or daughter, young son or daughter, wanted to start a lemonade stand, you could create a discounted cash flow model for the lemonade stand and figure out what the internal rate of return is. In theory, the cost of the table, the cost of the ice and the sugar and the lemons, etc. And then what is the consequence? What is the resulting cash flow that results in that? Well, they made $5 in day one, they made $8 in day two, they made $9 in day three, they made $13 in day four, and then ultimately the kid down the street, he bought the lemonade stand for $26 in his own little acquisition, right? What does that return look like over the course of time? Well, the discounted cash flow model seeks out to calculate the internal rate of return. If you don't know how to build one of these things, that's no problem. But I would suggest if you're going to do sale-leasebacks, these are fundamental finance topics that you absolutely need to understand thoroughly. We talked about valuing businesses, right? I gave you some of the secret sauce. A business is valued based on a multiple of their EBITDA. We talked about that, right? But if you're valuing a business from a return perspective, you've got to understand that there's a purchase price for the business, there's the resulting cash flows that come with it, and then you ultimately have to put together a projected sale price for the business once you've owned it for a defined period of time. This last bullet point here is important ratios to understand. If you don't understand these ratios, it makes it very, very difficult to understand the financial health of the guarantor. You need to understand the financial health of the guarantor because that's the biggest value driver for a sale-leaseback. So you have one of our ratios here is a fixed coverage ratio. And what does that mean? Well, fixed coverage or fixed charges rather are charges that are reoccurring and fixed over time. One of those could be your mortgage. If you're a business, it could be a mortgage. It could be just a debt payment on some other debt vehicle that you have. It could be a lease on either machinery or real estate. Those are all examples of fixed charges. A fixed coverage ratio takes the company's EBITDA and divides it by the sum of all the fixed charges that the company has to pay every single year. So if a company is doing, say, $1 million of EBITDA, that's the profitability of the company, and they have fixed charges of $500,000, you can safely assume that the fixed coverage ratio for that business is 2. $1 million of EBITDA divided by $500,000 of fixed charges. That's just one of numerous ratios that we use to calculate and to determine the financial health of the businesses that we do sale-leasebacks on. This next slide is an interesting slide. We just did a publication on the cap rate and interest rate convergence. What the heck does that mean? Well, interest rates, it's no secret that interest rates have gone up. And cap rates, specifically for sale-leasebacks, have gone down. Why is that? Industrial sale-leasebacks, specifically, have received a ton of institutional interest, private capital interest, and overall interest from real estate investors across the globe. As more competition enters the space, cap rates get compressed and values increase over time. Now, what's interesting about this is that as interest rates have risen, cap rates for sale-leasebacks have not risen by the same tune. The difference in interest rates and cap rates right now, specifically for industrial sale-leasebacks, is actually quite similar. Why is that relevant? Well, a sale-leaseback is a corporate financing tactic. It's a way of financing your business. And when a business owner is looking at different options for financing their business, the number one question they ask themselves is, well, what is the cost of that capital? If I take on an equity partner, I'm going to owe him a return. If I take on a bank, a loan, well, I've got to pay them an interest rate. That's the cost of capital. Interestingly enough, in today's day and age, the difference in cost of capital between doing a sale-leaseback and taking on a mortgage is not much different. Today is a great time to do sale-leasebacks still, even as interest rates increase. The next slide that we have here is more or less, let's see, did I repeat? Yeah, the valuation of sale-leasebacks, it's very, very, very simple in terms of NOI divided by cap rate. Yes, that's for sure. But determining that cap rate is actually, it could be all over the place. The cap rate for a given sale-leaseback could be a 5% cap rate. It could be a 10% cap rate. I did a distressed turnaround sale-leaseback in Pennsylvania not long ago, where the cap rate was actually 11 or 12%. That was because the company had a lot of debt on the balance sheet, and the profitability of the business was not very strong. That was more of a defensive sort of sale-leaseback. Whereas if you had a different sort of company that was extremely healthy with no debt on the balance sheet, the cap rate could be 7, it could be 6, it could be 5, it could be 4. It totally depends on the financial health of that business. So don't go missing the mark by a mile because you don't understand these ideas. Another important thing to understand right now is the different asset classes within the sale-leaseback world. Obviously, you've got 4 major food groups here. You've got retail, office, multifamily, and industrial. We don't see really any sale-leasebacks of multifamily buildings. For the sake of this discussion, we're going to limit it to retail, office, and industrial. Why is this important to understand? Well, different asset classes demand different cap rates. Right now, amongst industrial, office, and retail, industrial has the lowest cap rates of those 3 asset classes. Why is that? Well, you can think of a cap rate as being a measurement of risk. You've heard the term low risk, low return, high risk, high return. Well, that applies here. Today, from a macroeconomics perspective, industrial properties have performed the strongest of all the asset classes, excluding multifamily, in the wake of COVID. After and amid COVID, as you guys I'm sure all know, retail has struggled. Office companies are downsizing and reducing their footprints. The Amazon effect has permeated the entire United States and really the global economy. And who is the beneficiary of all these different things that happened in the world during COVID? Well, industrial absolutely killed it during COVID, a lot of those businesses were deemed essential. And if you ran a survey like we did every 2 weeks of all the publicly traded REITs and their industrial holdings, you would have found that in the heart of COVID, industrial real estate investment trusts were collecting on average 95% of their rents, 95% occupancy. Now, if you were to look at those same occupancy levels for office and retail, they were substantially lower. So what has happened over the course of time since COVID? Well, a lot of institutional capital sources, that's insurance companies, sovereign wealth funds, pension funds and endowments, private equity firms, the smart money, as we call it. The smart money is realized, well, we better get our money into the safest asset class, which right now is industrial. So a lot of the institutional capital sources pulled the plug from retail and office properties and reallocated their capital to industrial. So today we're seeing almost a twofold increase in the buyers for different sale-leasebacks that we're working on in the industrial sector. I want to talk about different types of sale-leasebacks and where they are applicable. Earlier in this presentation, we talked about estate planning sale-leasebacks. What do I mean by estate planning sale-leasebacks? Well, as I mentioned before, we're talking about a business owner that wants to harvest the fruits of their labor. They've got a second or maybe a third generation in the business, but relinquishing the equity or selling it to an equity company or selling it to a competitor might mean that the second or third generation gets elbowed out of the business, doesn't get to be the CEO or the head of marketing anymore, doesn't get to take home that massive salary that family businesses are accustomed to paying to their kin, right? So alternatively, these companies will say, well, I don't want to sell my business because I want to keep my kids or my grandkids in the business. So then they look to a bank and they'll take out we can look at taking out a senior loan, a massive refinancing of the business. That would be a great way of creating a liquidity event for the business. Well, in that event, you're now burdening that next generation with covenant-ridden bank debt. The bank breathing down your neck every night and sleepless nights for those next generations. A lot of business owners prefer not to go that route. Today, there's now a third option for business owners to create that liquidity event, to go buy that yacht in Miami or that condo that they always wanted in Naples. And that's by doing the sale-leaseback. And the sale-leaseback allows you to not give up your equity, and it also allows you to avoid dealing with covenant-ridden bank loans. Now, I've got a section here about UPREITs. What is an UPREIT? Well, an UPREIT is, you can think of it as very similar to a 1031 exchange. If you don't know what a 1031 exchange is, I suggest you Google it and learn it. It's important to real estate investing. It's a way of deferring taxes. And what an UPREIT is, it's very similar. It acts in the same way as a 1031 exchange. It's an arrangement where a real estate investment trust or a REIT acquires your property, say in a sale-leaseback scenario, and instead of giving you cash, they give you shares in the publicly traded REIT. Why is that relevant? Well, it acts in the same way as a 1031. Your capital gains taxes are completely mitigated by doing that. And what you're doing is, say, if you own a building in Livonia, Michigan, or in the outskirts of Toledo, Ohio, you've then traded that building for shares in a REIT that have exposure and diversity across hundreds or thousands of different markets, hundreds or thousands of different tenants, hundreds of different industries. So you're really creating a lot of diversity in your general portfolio, and it's a great way of mitigating capital gains taxes, creating diversity across your entire holdings, and it can also act as a staging ground for eventually finding a 1031 exchange property. So interestingly enough, you can park your money in the REIT, you keep the shares, and then when that golden opportunity comes around, you can then purchase the property and do a 1031 out of the shares and into the property. I find that absolutely incredible. The next type of sale-leaseback is the business growth sale-leasebacks. Business growth sale-leasebacks. That's a lot different than the estate planning, which implies that the owner is slowing down. The business growth sale-leasebacks, that implies that the owner is really starting to rev it up, right? A lot of young entrepreneurs and CEOs and fast-growing businesses are often faced with the question of, well, how am I going to use, where am I going to get the capital to finance this growth? Now, interestingly enough, we've done this dozens and dozens of times over the last decade, where a company sells their real estate at a 25 to 50% premium above appraised value. They use those proceeds then to buy another location or to buy a competitor or to invest in new machinery that increases the output and the revenues of the company. And then let's say it's another location, in this mini case study with the 3 boxes here. You own a piece of real estate, you sell it at 25 to 50% premium above the appraised value. You buy another location, expand the output and expand the bandwidth of the company. And then you do a sale-leaseback on that building and you get a 25 to 50% premium above the appraised value. And then you just copy, paste, repeat. It's a pretty amazing strategy to grow your business. Now, we've done this many, many times for companies that are gearing up for IPO or gearing up for an eventual sale, but they need to bulk up the business. This is a beautiful way of financing the growth without diluting your equity in the business, or alternatively, as we talked about before, taking on that bank debt that no one likes. Third concept here, which we alluded to briefly earlier, are the idea of turnaround or workout sale-leasebacks. Using sale-leasebacks defensively instead of offensively to build your business. In 2008 to 2010, we saw a lot of sale-leasebacks that were defensive in nature. These were sale-leasebacks that were used to delever the balance sheet or settle partnership disputes. These were sale-leasebacks that were used to create capital to allow the company to live to fight another day. I think in today's recessionary sort of economy, we're going to start to see a lot more turnaround and workout sale-leasebacks. We expect that to happen. Like I said, when we did the sale-leaseback in Pennsylvania for a distressed company, the cap rate was much higher. Why is that? Well, financial health of the company, as we talked about before, is the most important value driver for a sale-leaseback. So in that particular situation, we're talking about a cap rate in the low 10, 11, 12% return range. Pretty incredible compared to some other sale-leasebacks that we've worked on that have been in the 5 or 6% cap rate range. We'll talk about buyer types. I think this is important. There's 3 different buyer types as I see it. There's institutional buyers, there's private investment firms, and there's private capital. Institutional implies, think mega conglomerate capital sources. This would include insurance companies, endowments, pension funds, sovereign wealth, publicly traded REITs, real estate investment trusts, or even very large private equity firms. I'd classify those all as institutional type buyers for sale-leasebacks. There's also the private investment firms. We all know the private investors around here, private investment companies, right? These are established companies with a legal team and an underwriting team, but they're not necessarily institutionally capitalized. A lot of these private investment firms are raising money from family and friends, wealthy individuals, but not necessarily institutions. The third level of buyer types are what I call private capital. These would be wealthy entrepreneurs or accountants or lawyers that dabble in real estate and buy investment properties as a hedge on their overall portfolio. These are the 3 different buyer types that we see in the sale-leaseback world. But really, if you're trying to maximize value and ensure that you're going to get the highest level of certainty of close, you really need to have relationships with institutional capital sources to make that work. Reason why I bring this up is I don't want people to miss the mark anymore. I've seen people get in trouble legally for missing the mark, for misrepresentation or negligence of their fiduciary responsibility. There are folks that have traded sale-leasebacks to just one buyer. I'll tell you, on average, in the last 2 years, our team has generated an average of 13.5 offers per sale-leaseback transaction. And if you're not generating that sort of competition for the sale-leaseback, you could run yourself into some trouble as the seller finds out that, hey, sale-leasebacks are a little bit more popular and a lot more competitive than what was ultimately marketed, and we ultimately left money on the table. We don't want to see that. Which brings me to my last point. I want to talk to you guys today, and I wanted to do this not so I could have people trying to figure out how to do discounted cash flow models and calculate internal rate of returns. I wanted to bring this up to you folks because I want to partner with you. I want to help you. If you had a sale-leaseback or an idea for a sale-leaseback or a business that you wanted to pursue, call me. I would be so down and so fired up, so excited to help you and come to the meeting with you, shirt and tie, and we'll help and we'll work together. We'll split the fees and we'll make sure that the number one most important thing is secured, and that's maximizing the value of the real estate for your client. Too many times, I've mentioned it before, I've seen sale-leasebacks that were transacted where there was significant capital left on the table. In order for you to maximize value for your client, it's imperative that you work with the experts. Now, we're approaching almost $1 billion of volume over the course of the last decade, and I would like to say that, I think at least in this the Commercial Board of Realtors' eyes, I think I'm an expert in this field. In addition to this, it's not just the brokers that you should be working with a sale-leaseback expert broker. If you do tenant representation, if you sell empty buildings, if you sell land or do build-to-suits, chances are you're not a sale-leaseback broker. I can tell you those are all things that I don't do. I only do sale-leasebacks. So the next thing I think that's important with sale-leaseback and engaging sale-leaseback experts is finding the right attorney. Sale-leasebacks are extremely legally intensive, right? You have to put together a lease. You have to put together a PSA. There's tons of due diligence, both on the operating business side and on the real estate side. So it's extremely important that you're working with a sale-leaseback savvy attorney. I've seen it before where a seller of a sale-leaseback client hires their cousin or hires their estate attorney or the family attorney to go try to run through the sale-leaseback gambit, and only to come back with a lack of competency, an increased time, a decrease in execution certainty, and egregious fees because they weren't able to execute quickly. The last thing here that I think that's important in terms of engaging experts is knowing which vendors to use. When I say third-party vendors, I mean environmental, title, and survey. For some folks here, they might say, well, I'm just going to call XYZ title company, or I'm going to call XYZ environmental company. Not so fast. The sale-leaseback investment world, which is predominantly dominated by institutional investors, there is a preferred third-party vendor list that these folks have. And if you end up getting an environmental report with the wrong vendor, boy, you could be making a critical mistake because you'll have to redo those reports to make it acceptable to these institutional sort of investors. This is just a number of transactions that we've done over the course of time, from retail to industrial. Last year, our average deal size was about 21 million, but as you can see right here, we work on deals as small as 2 or 3 million. And then the last here, I know I said it to you before, but I'd love to work with you guys. As you can tell, I'm extremely energetic and extremely passionate about sale-leaseback idea. And the reason why I got on here was I want to help people. I want to help people make money, and I want to help people maximize the value of the real estate by doing sale-leasebacks. And I'm tired of seeing sale-leasebacks done the wrong way. But hey, if you have something that you think you've got a hot prospect, or you've got a business that you think might be a good fit for the sale-leaseback arrangement, call me, and I'll be fired up and passionate to come to your meeting, shirt and tie, ready to go. We'll land the deal, and we're going to make something happen for those people. Because when you work with me and you work with my team, you can guarantee maximum value, maximum competitive tension for that sale-leaseback assignment. Thank you so much, everybody, for listening to me today. I really appreciate it. Not sure if you guys just turned it on mute and just let it ride, or if you actually listened to me talk. But in either case, I really appreciate the time today, and I hope you guys go out there and kill it. Thank you.